Happy Thursday. Let's see. Are we good? Oh my gosh, it looks like we are, guys. Are we actually working everywhere we should be working? I think we are. That would be weird. Usually I have issues with something. So as you're jumping in, welcome. I always just have to make sure that I'm actually streaming everywhere. I think I should be streaming because I tend to miss a platform or something. So let's see. If you jump on, let me know where you're watching: Facebook, YouTube, um, LinkedIn. Yeah. Otherwise, I'm going to just do a quick check here. And looks like we are sitting pretty. Yay! All right. Happy Thursday. If you're here in Colorado, happy snowy Thursday. That is not showing. Hold on, guys. Sorry. It is not showing that on this page. Let's see. Hey guys, as you're jumping in, let me know where you're watching from. And I'm just making sure that all of our platforms are indeed working. All right, welcome. We're doing another Q&A today. So I do want everyone just a minute or two to jump in, because if you joined me for a Q&A session before, I'll kind of go through how it works. I have a few announcements I want to make sure that I get out there: BOI reporting, tax deadlines, things like that. And then I will jump into anyone who is live, who puts their comments who puts their questions in the comments. Let me make sure my comments are up. There we go. They will get answered first, because I want to appreciate your time for taking your time to be here with me live. So I'll answer those questions first, and then I have a list of questions that people either emailed, DM'd me, or just asked since I said we were going live, because they knew they wouldn't be able to make it, that they want me to answer. And then I just have a bank of questions that I've been asked from like our clients over the last few weeks that I added here if we need some filler time. Don't usually need it. 30 minutes goes by pretty darn fast. So welcome. If you are new here, hi, I'm Bree Beers. I own Bree Beers and Associates in Denver, Colorado. We are tax advisors. We specialize in tax advising strategy planning for small business owners and their businesses themselves. So we really focus on not just the tax return, right? We do tax returns, that's great. But what we really focus on, and what we're trying to build with our clients and with new clients, is that tax advisory piece, that ability to help you implement these tax strategies that we tend to think are kind of reserved for the rich, right? We talk about these, and sure, there are some that only apply to the rich, but in general, our tax code is really built for small business owners of all sizes. All right. It's just that the rich people have the resources, they have the people, they have the time to take advantage of all the loopholes, all the rules, all the loopholes within the tax code that allow them to reduce their tax liability. All right, legally and ethically. We're talking about the ones that do it legally and ethically. You guys can also do that as small business owners. You do not have to be a millionaire or billionaire to take advantage of our tax code here in the United States. What you do need to have is understanding of the tax code, or somebody on your team that does understand the tax code and what needs to be done to take care of the different loopholes, right? Because it's not, the tax code is written in a way that we as the taxpayers have to show our reduction in tax liability or income or whatever it is we're trying to do, and prove that, right? And prove that we are doing this in a legitimate manner. So that's what we help you guys do. We help with tax planning. We have maintenance plans here where we work with you year round to help you implement those strategies and stay compliant with them, because that's the next hardest part, right? The first part is, okay, what do I qualify for? What strategies can I implement? Okay, how do I implement them? Great, I have everything to implement. Now I'm gonna remember to actually do it, right? So that's what we help you with. So anyway, that's a little bit about me. So I am here every Thursday at 10 a.m. Colorado time. So with a few exceptions, we had the last 2 weeks off for holidays. But in that, I'm here, every week. Normally, we will have a topic that we train on. Usually it's a question I get asked a lot that's just a little bit more, you know, robust than a quick Q&A. All right. So starting next week, we'll do that. But I think we're probably going to start doing monthly Q&A sessions because we do get a lot of really good questions in throughout the year that I would love to answer. So nothing's set in stone yet, but I'm going to guess that the first Thursday of every month is going to be Q&A time. The rest of our sessions will be training. All right. But every Thursday at 10 o'clock Colorado time, I'm here. Snow, sunshine, or otherwise. All right. So I'm going to jump in again. If you're joining us live, go ahead. If you have any questions, put them in the chat. I will always put priority on those questions. Otherwise, I have a couple of questions that I got in over the last week through DMs and messages that I want to address. I've gotten a lot of Colorado specific questions, which I will be able to address, but also address those of you out of state as well to a certain degree. All right, so let me jump into my little spreadsheet. Okay. All right. So, sorry, my liver hurts. Okay. So one thing I got is, first of all, let's start with, before I jump in, I did want to talk about BOI. BOI reporting, business ownership information. I feel like we've been talking about this nonstop for the last 6 weeks. So the week of Christmas, shit hit the fan. Like, excuse my language, but like, so like the Monday before Christmas, they were like, so BOI reporting, let me back up. So if you're like, what the hell are you talking about? BOI reporting, business ownership information. So this is a report that they said starting in January of 2024. So this year, they want information on all owners of small businesses, all right? And it's run through FinCEN. There's a link that you go into. It was a super quick and easy form to fill out. We didn't do it. It's not an accounting. It's more of a legal document that you do, right? And then you update it as your ownership changes or if ownerships move, the owners move, things like that. All year, it was in place for businesses that were in existence, and new businesses had less time to file it. Existing businesses as of January 2024 had until December 31st of 2024 to file this report. We didn't file it because it's not an accounting form, it's more of a legal form, but we advise, clients, this is due, go ahead and do it. But we also were like, not really positive this is going to stick around. Sure enough, beginning of December, a court overturns it. Says this BOI reporting is not unconstitutional. It is not required. There's a hold on it. Okay, so they put a stay on it. The freaking Monday before Christmas, when none of us are trying to work, right? They reverse this. They say no, it is due. All right, we do need this report. It is legal. We're going to do it. And then the next day they said, but we're going to give you till January 13th to do it instead of January 1st. And then the day after Christmas, another court was like, just kidding, it is illegal. We're going to put another stay on it. So that's where we're at right now. There's a stay on BOI reporting. All right. That said, if you are the type of person who does believe that this is an invasion of privacy and you don't want it, you don't agree with it, it's fine. You do not have to do it right now. Right now, it is voluntary. That said, if you do not care, right, and you're just like, I'm sick of hearing about this, go to the website. I think it's fincen.gov, but it is free to file. It takes less than 10 minutes. And fill it out. All right. That way you're compliant. If it does stick around, if it goes away, no harm, no foul. All right. My guess is under the new administration, they will probably side on the side of this being an invasion of privacy, and they will get rid of it, or they will just have other things to deal with, and they'll just kind of shove it under the rug. That's my guess, but I don't know. We will keep you updated and let you know where things are with this BOI reporting. All right. So the number one question, now into the questions. All right. So first and foremost, I got a lot of questions varying around when are my business taxes due. All right. And this depends on the type of business you have. All right. And first of all, I want to know that we are talking about business income taxes. all right? There are other business taxes that you may be responsible for as a business owner, all right? You may collect sales tax and have to do sales tax reporting. You may have property income tax or property taxes that you have to pay. You may have real estate or real property taxes due. Use tax, what is that? Sales and use tax kind of goes hand in hand. We are talking about income taxes, right? Our annual income tax returns that we all file on a personal level, right? Due April 15th. I get a lot of questions around, well, when is my business return due? All right, when do I have to pay those taxes? Right? And that depends on the kind of business you are. If you are the type of business that reports on your Schedule C, okay, so if you're a sole proprietor, meaning you're doing business under your Social Security, or maybe you have a DBA, if you are a single member LLC, all right, you guys are reporting your business activity on Schedule C of your personal tax return, all right? Your business does not file a separate tax return. With me? Your business activity is simply an additional form that you must file within your personal income tax return, all right? Therefore, your business tax return is due when your personal return is due, which is April 15th, all right? Changes if there's holidays. This year, I think it's on a Wednesday. So no extensions or no delayed deadlines this year. All right. If at any time you're ever not ready to file, not that you're not ready to pay, but that you're not ready to file your business return. Maybe you're behind. Maybe you have something come up that you just cannot get your prior year financials in order. By April 15th, you want to file an extension for your personal return, which will give you till October 15th to get that filed without incurring the failure to file penalty. That is the steepest of all penalties. All right, there's tons of penalties, but the failure to file is 5% of what is due per month, all right, on a personal return, which if you're a Schedule C business, that's where you're filing, okay? So if you have a separate business entity set up other than possibly a single member LLC, okay? So if you are a partnership, then you are filing a 1065, right? Or if you are being taxed as an S corp, then you are filing an 1120X. Those two returns are due March 15th, all right? Same thing, if by March 15th you aren't quite ready to file your return, you can file an extension, which gives you till September 15th. Filing that extension is so important for these business returns because the penalty for those late filings is, I can't remember, it was $205 last year, $205 per owner per month. So even if you're one owner and you're 1 day late, you're gonna owe over $200. All right, so filing that extension, it's easy, it's fast, make sure you do it, okay? So the days to remember, if you're an S corp or a partnership, March 15th is your filing deadline. If you are a C corp or a Schedule C business, April 15th. Okay, that's your filing deadline. Now I get the question of, well, when do I pay my taxes? That's a whole nother beast, all right? So when you're an S corp or a partnership and that tax return is due March 15th, you don't typically pay any taxes with that. There's no federal tax due. Depending on your state, you might have certain state taxes due, depends. But it's simply a reporting instrument, you guys. When you are a partnership or an S corp, you are in what we call a flow-through entity. So that tax return report acts as just a reporting instrument, tells the IRS, okay, here's how much the business made, here's how much is allocable to each of the owners. Great. Now it is your responsibility as the owner to report that income on your personal return. So when it comes to the question of when is my tax money due, it all flows through and is due April 15th. Okay, because you're gonna get the bill for your taxes even if you are in S corp or a partnership when you file your personal return. All right, and then if you are a C corporation, your tax return is due April 15th unless you're on a fiscal year. All right, and that's when your taxes are due. I'm gonna caveat, right? Because I don't want you to have taxes due with your tax return. All right, I am a firm believer in paying your estimated tax payments and paying those in, because when you wait, I also don't believe in a big refund either, but we'll talk about that in a separate section. When you owe money with your tax return, you guys, all right, you are going to have some penalties and interest accruing on there, okay? Even if you do it on April 15th, you are still going to see a penalties and interest schedule typically, because the IRS really wants their taxes when you earn the money, okay? And that's part of the reason we have and calculate those estimated tax payments, okay? And those estimated tax payments, again, we've talked about, there's a lot of different types of penalties that the IRS wants to assess you guys. One of them is the underpayment penalty, all right? So the underpayment penalty says in 2024, all right, that's the year we just passed, right? That just passed in 2024, each quarter, were you paying in at least as much as you owed for each of those quarters the year before? Because if you paid it 90%, they want at least 90%. Because if you're paying in at least 90% of what you owed from the prior year, even if you owe more this year because you had a more successful year, you're going to avoid the underpayment penalties, okay? If you don't pay by the end of the year, if you owe more than what we estimated based on last year, okay? If by the end of the year you haven't paid in what you actually are going to owe for this year, then the clock starts ticking on late payment penalties, all right? And they're minimal, 0.05% of what you owe per month. So they're not a lot compared to that failure to file penalty, but it's still money. Like, why incur an unnecessary expense, right? So that's why we pay those. That's why we always calculate and prepare those estimated tax payments, so that we can pay and avoid any of those late payment penalties or those underpayment penalties, any of the IRS payment penalties, okay? The other reason we believe in estimated tax payments is because we believe, same thing kind of as the IRS, we want the money to come out of our account when we earn, closer to when we are earning it, all right? And this is especially true if you think of, if you're in a business that is cyclical, or maybe you have up years, down years, right? If 2024 is a really good year, right? You're making tons of money, you're having a great year, and now at the beginning of 2025, it's slow, but you didn't make those payments, or you don't have that money, and now when you go to do your tax return, you're going to owe for last year, you no longer have the cash because you had it then, and now you spent it, and now you don't have it. So by making those estimated payments, we don't have to worry about that. We avoid that timing issue. All right. So that was a long question to when are my taxes due? But that's a question when people ask that, they're not always asking the same question. Sometimes they're asking, when is my tax return due? Sometimes they're asking, when is my money due? The other thing I want to tell on this before I go to the next question is, when it comes time to file your tax return, okay? When April 15th rolls around, right? We get a lot of clients that are like, yeah, I'm ready to file, but I don't have the money, so I want to hold off filing. Like, what I always suggest to people is get your return filed, all right? And then work on your talk with the IRS and set up a payment plan, okay? Because the misconception that people have is that when you file an extension on April 15th, right, that gives you until October 15th to file, that is only an extension to file. It is not an extension to pay. So you're going to be accruing penalties and interest for not paying anyway. So go ahead and file, get it in the system with the IRS, get on a payment plan so they know you're not avoiding that, and start making payments toward that balance. All right. So to start background, what is the deadline for your tax returns? March 15th is when our 1120S's for S Corps and our 1065 for partnership returns are due. Not money, just tax returns. Then April 15th is when our personal returns are due, which is also when, if we're a Schedule C business, our business returns have to be filed within our personal returns, all right? And our C Corps. All right, another question I got, I think this came in yesterday, is, do I need to file a Colorado state tax return if I work in a different state but live in Colorado? All right, this person specifically is talking about Colorado, but generally speaking, this is going to go for most of our states out there. Okay, most of you that work, and this is if you work in a different state, then where you live, or maybe a very common one, right, is you have a business or real estate property in a different state. Okay. So typically, first of all, yes, if you're a resident, whatever state you're a resident of, you have to file a tax return for that state. Okay, even regardless of where your income is reported. All right. So yes, if you're a Colorado resident, you have to file a Colorado return. All right. That said, there's a good chance if you work in a different state, you also need to file a return for that state. And then without getting too complicated, what happens? So let's say I'm not going to use California because there's stuff's complicated. But let's say I work in Missouri. Let's go with Nebraska because they're right next door. So let's say I live on the edge, right? I live in Colorado, I work in Nebraska. I have to file a Nebraska tax return to report all the income I earned in Nebraska because that's where I work. Okay. Then I file my Colorado return and you get a credit on your resident return for state taxes paid to other states. Okay. So that's a misconception I tend to get. They're like, I'm double paying my taxes. No, you get credits in your resident state for taxes paid to other states. All state rules are different. And when you talk about states like California and New York specifically, I'm sure there's other ones in there, but those are two states we actually stopped taking new clients in because their rules are very complex. Their state returns are very complex compared to other states. The credits might not offset, right? So if you're a California resident with a 15% tax rate or a fluctuating tax rate, and you work in Colorado where we have a 4.2% tax rate, all right, you're not gonna totally offset your income, but you are gonna offset some of that income. All right. The flip side to this that I get a lot of, okay, and this is important if you guys are buying real estate or starting businesses, a lot of times attorneys will tell you to start businesses in other states. All right. They'll say set up a Wyoming because they have no income tax. Set it up in Delaware, which Delaware is all legal stuff. That makes sense. That's a legal side of things. But you will hear someone say, set your business up in a state with no income tax so you don't have to pay income tax. That's not how it works. All right, unfortunately. So if you have, because if I set up my business in Wyoming, I'm like, yeah, this is a Wyoming business. Sure, but there's a thing called Nexus. This says, okay, well, do you have employees in Colorado? Do you have clients in Colorado? Do you have a physical presence in Colorado? Okay, well, that's the case, then you have what they call Nexus in Colorado, and you actually have to be filing a Colorado return for that income. All right, so the IRS has found out our sneaky ways of trying to get out of paying state income tax. It's not the IRS, it's the state. But the other thing is, the other thing to think of here also is if I'm in Colorado, but I have a Florida rental property, not Florida, they have no tax. If I have a Mississippi rental property, I have to file a Mississippi return to report that rental income on that rental property. Okay. So if you're dealing, so the moral of the story, guys, is if you are dealing in more than one state, figure out if you have to be filing in more than one state, because some states also have de minimis rules that says if you don't hit a certain threshold of income, then you don't have to file here. Okay. Let me just make sure I can hear myself. Okay. Yeah. All right. Let's see. What is my state income tax rate? Depends on what state you live in. I have Colorado's memorized because I live here. And for 2024, our state income tax rate was 4.2%. You think I should probably know 2025 by now, but I'm still thinking about, guys, I just got done doing 2023 returns. I still have 2023 on the brain. Colorado income tax rate. Let's just pick, I think it stayed the same. Nobody's telling me. No, it'll increase in 2026. So there's that. All right, so each state is different. Some have flat tax rates like Colorado. Some have no income tax like Texas, Florida. I think there's 5. Washington or Oregon. I get them confused. Not a geography person. But there's some states that have no income tax on the state level. All right, and there's some that have a marginal tax rate that kind of mimics our federal tax rate. All right, and that leads me into my next question of what are tax rates and what do they mean? I've gotten questions of varying degrees on this. So we tend to hear things like I'm in the I'm in the highest tax bracket, right? In the highest tax bracket. What does that really mean? All right. Well, first of all, the highest tax bracket is 37%. But we have what's called a marginal tax bracket here in the United States. And what that means is, so I wish I had a visual, but it's like a stepping stone, okay? So all of us, you, me, Jeff Bezos, your choice, all of us, okay, for the first, I think it's like 10,000 and some change that we make, all right, we pay 10% on those dollars. All right, we all pay 10% of the first 10,000 and some change that we make every year. All right, then the next one is 12%. We all pay 12% on that next chunk of money. All right, and then 15, and 18, and 22, 24, 28, 32, 37. Don't quote me on that. But the point is, all right, you're only paying if you step up a tax bracket, you're only paying that higher percentage on the dollars above the threshold where it changes. All right, let me pull up this year's numbers so I can give you 2025. I usually have these bookmarked, but I did not have 2025 updated yet. So for 2025, you guys, let me find it. This is a terrible link. There it is. Okay. So we're talking about single, okay? So if you're single and every dollar up to $11,925, if you're married filing jointly, it's $23,850. All of us are charged 10% on all of those dollars we earn up to that threshold. All right? And then it stair steps 12, 22, 24, 32, 35. 37, all right, listen to these. So 37, if you're in the highest tax bracket, if you are single, it means you're making over $626,350 in taxable income for the year. All right, if you're married, it is not double that, which is always weird to me, but it's fine. If you're married filing jointly, you are in the highest tax bracket if you make combined $751,600. All right, and being in the highest tax bracket means that I am paying 37% on all the dollars at or above that threshold. All the lower thresholds, I'm paying the 10, 12, 22, 24, 32, 35% on those dollars. Okay, that's important to understand because people get very confused by that. I've had people going, well, that raise is going to push me to the next tax bracket. So why would I do that? Everything I make, I'm going to be spending on taxes. That's not the case. All right. One other, I want to talk about, what time is it? It's about time. So one last thing I kind of want to talk to you guys about real quick are state tax credits and deductions. All right. In Colorado, we have the Tabor refund. All right. Each year, this number changes. Voters always vote to pay it back to us as taxpayers. The amount fluctuates, but you have to file a timely tax return in order to get this Tabor refund. All right, which means filing by April 15th or filing an extension and then filing your final return by October 15th. Right? If you file later than that or you don't file your extension, you're going to disqualify yourself from receiving that Tabor refund. All right. All states have different and unique tax credits and deductions. So check with your state or check with your tax preparer, and they can help you figure out what credits or deductions might be special and available to you in your state. Another thing Colorado has, and I think California, maybe New York, a couple states have in place right now, is called the PTET. All right. So this is for my business owners. All right. Follow me here. So pre-2017, before the Tax Cuts and Jobs Act was enacted, all right, we as taxpayers on our individual tax return were allowed to take all of our taxes, the state income tax and the state real estate taxes, all of the state and non-federal level taxes we paid, we were able to report onto our itemized deductions, our Schedule A of our personal return, and take those. Okay, we still can. But now the Tax Cuts and Jobs Act since 2017 has limited that to $10,000, which $10,000, when you're talking about your income tax and your property taxes, like your real estate taxes, not a high threshold, right? Especially if you are in a state that has high property taxes, like Texas, California, New York, or high income taxes like California, New York, other states, all right? That $10,000 really limits you, all right? In Colorado, it can limit you as well. Our property taxes are pretty low. Our income taxes are pretty low, but when you combine them together, $10,000 is not super hard to reach. All right, so what the PTET allows us to do, all right, is pay the state income tax, the 4.2% income tax that is due to our business. Remember, we don't pay taxes through our income taxes through our business, but if it's due to our business activity, we can pay it through our business and get a take it as a business deduction on our return, and then we get a credit for that. All right, so it's a way, it's kind of a workaround to this $10,000 limit. If this, I'm not going to get into details, but if this is you, okay, if you are in Colorado or another state that has the PTET, do not remember what that stands for, but to say, I say the letters because petite sounds funny. But if you're in a state that does this, talk to your tax advisor, all right? Because if you pay in your taxes for your business, you can get a business deduction on your return for that, all right? There's a lot of reconciliation. It's a little complicated on the tax side of things, but something we can help you with, all right? Okay, well, I want to thank everyone who joined me today. I saw a lot of people kind of come in and out. I appreciate you guys joining. For those of you watching on replay, I appreciate your time as well. Time is our, most precious commodity, and for you to come in and spend 30 minutes of your time with me on a Thursday morning, it does not go unnoticed. I appreciate it. So thank you. I will see you next week. I do not have the topic set for next week because I just haven't done it yet. But keep an eye on our Facebook page for that. And if you are looking for a new tax preparer this year, hit us up. We're still taking on clients. We will take on new clients. We take on new clients all year, all the time. But if you want to file by the March and April deadlines and not extend, we need you to meet with me for, if you have an S Corp or a partnership, make sure you get on the calendar with me before February 15th, 10, 11, 12, 13, 14th. That's a Friday. If you are any other type of, if you have a Schedule C business, then you have until March 14th to get on the calendar. To get on my calendar, we do free tax discovery calls. Let's see if we're a good fit to work together. See if we can help you, with your tax preparation. We also, like I mentioned earlier, we do a lot of tax advisory, and we now have an offering of maintenance plans, year-round tax advisory maintenance plans, where we help you implement tax strategies, lower your tax bill, and help you stay compliant with those year-round. So thanks again for joining me, guys. I will see you guys next week. Bye.